This video is all about helping you master 2 insanely powerful smart money concepts. In this video, I will share exactly what market structure shifts are and how to pinpoint snipper liquidity sweep entries. I'll show you exactly how trading market structure really works and how these patterns look on a price chart. Plus, and this is the fun part, I'll teach you a simple technique to enter trades using those liquidity sweeps for a potentially brand new trading strategy. My goal is that by the end of this video, you can start using this trading entry model yourself to spot good trading opportunities and try to improve your trading results. All right, now that we've said that, let's get into it and learn this SMC trading together. Okay, first up, let's talk about the first crucial idea, market structure. So, what is market structure? Let's backtrack to put it very simply. It's just the way the market is moving. It helps us see the current flow and behavior of the price. Think of it like reading a map for the market. Well, you know, there's a famous saying, the trend is your friend. And that is where market structure can help us, which is identify the direction of the trend. The thing is, knowing the market structure helps you figure out which way the price is really trying to go, up, down, or just sideways. This is super important because, you know, maybe the worst mistake traders make is being on the wrong side of the trend. Most traders try to buy or go long when they should sell, or sell when they should buy, but then the market reverses, therefore they lose. Understanding market structure helps avoid that huge problem. If you're struggling with knowing whether to buy or sell, mastering market structure will help you immensely. Here are the 3 main ways, or phases, markets usually move. First, we have an uptrend. This is when the price keeps making higher highs and higher lows. Think of it like walking upstairs. In an uptrend, we mostly want to look for chances to buy. And then we have a downtrend. This is the opposite of an uptrend. Here, the price keeps making lower lows and lower highs, like walking downstairs. In a downtrend, we mostly want to look for chances to sell. And the third way is consolidation. This is when the price is stuck moving sideways. During consolidation, keep in mind you do not necessarily want to be forcing trades because the direction isn't clear. Patience often pays off here. Now, in trends, price doesn't just go straight up or down. It moves in pushes and pullbacks. The strong push with the trend is called an impulsive move, and then the smaller move back against the trend is called a corrective move or pullback. Okay, we know price moves in pushes, impulsive moves, and pullbacks, corrective moves. Now on to the fun stuff. A really key signal we watch for in market structure is called the break of structure, or BOS. Understanding this is vital if you want to have a good understanding of how to identify the direction of the trend. So, what exactly is a break of structure? In an uptrend, remember, price is making higher highs and higher lows. A BOS happens when a strong impulsive move pushes up and breaks through the previous swing high. Check this out on the chart here. See that? It shows the buyers are still strong and the uptrend is likely continuing its market direction. In a downtrend, a BOS happens when an impulsive move pushes down and breaks through the previous swing low. This signals that the sellers are in control and the downtrend wants to keep going. This BOS is a fundamental concept in price action trading and helps us with structure mapping of the trend. Now, here's probably the most important thing about the BOS. How do we know if it's a real or a valid break of structure? I found out the hard way that not all breaks of structure are created equal. Sometimes, price might just quickly poke the wick past the old swing high or swing low, but then the candle body closes back inside the previous trading range. This might just be a quick grab of orders, and it is not what you think it is in terms of genuine trend continuation. This is called a liquidity sweep, but more on that later. Therefore, for a more reliable signal, or a valid BOS, we really want to see the candle body close clearly past that previous swing high or swing low. This will give us much stronger confirmation. So, what happens after we spot a valid BOS? After a valid BOS to the upside, we have a new higher high. But price often takes a pause after that, making a pullback. Traders often watch this pullback or correction for potential buy entries, expecting another impulsive move up. The way I knew that this pattern repeats is through extensive back testing and tracking. And after a valid BOS to the downside, we get a new lower low. Price then often pulls back up. You might want to look for sell opportunities around this pullback area. Spotting these valid breaks of structure is absolutely crucial. That point was super important, but if you don't also couple it with understanding the context like liquidity, which we'll get to shortly, then you might still get caught on the wrong side of the market. Keep in mind you do not just trade every BOS. Market structure itself isn't a complete trading strategy. It's just a foundational concept. Mastering structure mapping is just a key first step. But without this next step involving liquidity, you're missing a huge piece of the puzzle. However, before we get into that, I want to share another secret. Now, if you're struggling with spotting these key swing highs and swing lows perfectly, you know, looking at a real chart can feel messy sometimes, and it takes practice to map your charts correctly. But the good news is, there's one secret way to get around this initially using a common tool found on most charting platforms like TradingView. We are talking about the ZigZag indicator. This will help you visualize the price structure much faster. Think of the ZigZag indicator as a helper tool. It automatically connects significant swing highs and swing lows points on the chart, giving you a quick visual representation of the market structure. The thing is, by seeing these pivots clearly marked, the ZigZag indicator can also help you visually spot potential breaks of structure, BOS. But here's the real key. I'm going to show you a little hack to make it insanely useful for seeing detailed price structure. I'll explain why in just a second. Most charting platforms let you adjust the indicator settings. For the ZigZag indicator, find the setting like price deviation for reversals percentage. Here's the trick I found out works best. Change that number to 1. Why 1? So if you're doing structure mapping manually and it feels tricky, you should be doing it this way, using the ZigZag with the deviation set to 1 as a guide to start training your eyes. It's a great visual aid. All right, let's move on to the next massive piece of the puzzle, which is liquidity. Now, that point about structure was super important, but if you don't also couple it with this next one, then you're missing half the picture. Let's learn about liquidity, which can be your best friend or your worst enemy in trading. Let's backtrack to put it very simply. Liquidity is like hidden pools of money or orders sitting on the price chart. Knowing about liquidity is one of the best ways to potentially improve your trading and understand why the price moves the way it does. I'll show you why in just a second. However, if you don't understand liquidity, you might find yourself losing trades repeatedly. It's a huge problem many traders face without realizing it. It can feel like the market is specifically targeting your stop loss. I'm going to show you exactly what liquidity is, and more importantly, I'm also going to reveal the top 4 places where it typically hides on the price chart. This will help you avoid those common traps. Understanding this is critical for our brand new trading entry model. Coming up, we'll put liquidity and market structure together. So watch closely. This will help you immensely. So, what exactly is liquidity in trading? In simple terms, liquidity refers to where orders are sitting. These orders include buy stops, sell stops, and stop losses. Now, why should we care about all of this? The thing is, the market needs liquidity. Big players, banks, institutions, and hedge fund managers, they have a huge problem. They need massive amounts of orders to fill their positions, but they can't reveal their hand too early by just smashing market orders. Instead, they need to find areas where lots of opposite orders are waiting. So, where do these insane pools of orders build up? Here are the most common areas. First, the liquidity builds above below key swing highs and swing lows because retail stops and breakout orders cluster here. Second, support and resistance levels are obvious zones that attract orders and stops. Equal highs and equal lows are another obvious spot for liquidity pools. Check this out. When price makes equal highs, double tops, or equal lows, double bottoms, you can bet there's a massive cluster of stop losses and breakout orders just above or below. These are like magnets for price. Trend lines are lesser known to attract a pool of liquidity, but many traders place orders or stops along trend lines. Because so many traders use these same basic trade ideas, their orders get clustered, creating these juicy pools of liquidity. Now, here's the real key to this, something called the liquidity sweep, also called a stop hunt or a stop raid. This happens. Big players need liquidity, but then simply buying or selling pushes the price against them. Therefore, they sometimes engineer moves into these liquidity zones. Price will spike just above a key swing high, hitting buy stops and stop losses, or dive just below a key swing low, hitting sell stops and buyer stop losses. This often looks like a nasty false breakout. The price breaks the level, grabs the liquidity, and then quickly reverses. The big players are using that stop hunt to fill their own large positions. Okay, let's get real for a second. This whole idea of stop hunt's engineered by big players. Do you actually buy it? Or do you think it's just a convenient story traders tell themselves when they get stopped out? Drop a comment. Are stop hunts real or just an excuse? I want to hear your honest opinion. Understanding liquidity sweeps is insanely powerful for 2 main reasons. First, you avoid being the liquidity. I think this is probably the most important thing that you need to be doing. If you know where liquidity likely rests, like above equal highs, you avoid placing your stop loss right there with everyone else, saving you from unnecessary stop outs. Second, you can find high probability entries. Instead of getting caught in the sweep, we can use it to our advantage. And in just a minute, I'll show you how to use this liquidity sweep as part of our powerful entry model. After price performs a liquidity sweep and starts showing signs of reversing, it often presents a fantastic trading opportunity. Technically, a liquidity sweep looks similar to a break of structure, so you might be thinking, how do I tell the difference between a liquidity sweep and a real BOS? So I'll address that right here. Context matters. If the price breaks obvious equal highs but the higher time frame market structure is still bearish, it's more likely a liquidity sweep designed to fuel a move down. Therefore, if the price breaks a high without obvious liquidity sitting right there and it aligns with the higher time frame uptrend, it's more likely a genuine BOS signaling a trend continuation to the upside. So, liquidity isn't just random noise, it's the market's fuel. But Without combining it effectively with a market structure shift, it's harder to capitalize on this knowledge. By understanding market structure and identifying liquidity, we can anticipate these liquidity sweeps, and that sets us up perfectly for the next crucial step, using a market structure shift after a sweep as our confirmation. This is how we start creating powerful price action entry techniques. It's a science with a proven formula. Okay, now on to the really fun stuff. Let's put market structure and liquidity together to create our brand new trading entry model. I'm going to show you exactly how this brand new trading approach works step by step, focusing specifically on those insanely powerful equal high and equal low sweeps. When we put these together, we get a powerful way to find high probability trading setups. I've done the work refining this, and now I want to share it with you. Here are the 3 main steps. First step is to identify the liquidity sweep. So scan your charts and specifically look for areas where price has formed clear equal highs or equal lows. It's very important to wait for the price to make that clear breakout beyond these levels to grab the orders. For equal lows, the price must push below. For equal highs, the price must push above. This price manipulation is the liquidity sweep. The step number 2 is to look for the market structure shift. This next step is even more important than the last one. Immediately after the liquidity sweep of the equal highs lows, watch for a strong reversal and a change in price action. If the price swept equal lows, we need to see a strong rally that causes a break of structure, BOS, by closing above the most recent swing high. If the price swept equal highs, we need to see a strong sell-off that causes a break of structure by closing below the most recent swing low. This market structure shift, the BOS against the sweep direction, is our confirmation that the sweep was likely a trap or reversal setup. But that's not all. Now, the step number 3 is to enter on the first pullback to nearby supply or demand zone or a fair value gap or even an order block. Once you have the liquidity sweep and the confirming market structure shift, BOS, be patient and don't chase the price. Wait for the price to make a small pullback. Here's how I got this trade right often. For a buy setup, equal low sweep, then bullish BOS. Look for the price to retrace down into a nearby demand zone or order block, often near the start of the move that caused the BOS. For a sell setup, equal high sweep, then bearish BOS. Look for the price to rally into a nearby supply zone or order block, often near the start of the move that caused the BOS. So, let's backtrack to put it very simply. The flow is this: liquidity sweep, then market structure shift or BOF, then pull back to supply demand zone or an order block, and then entry. If you liked this explanation and found it helpful, please do me a huge favor and smash that like button. It really helps the channel. And subscribe if you haven't already for more brand new trading insights like this. Now that you've mastered these 2 game-changing SMC trading secrets, there is one more trading strategy that nobody knows about. In this next video right here, I dive deep into exactly how I use DeepSeek AI to automate a trading strategy based on a common technical indicator and generated 1,452% in profit. So if you want to also be able to avoid getting stopped out and arranging market, click the video on the screen right now.